Hello, everyone, and welcome to our presentation. All of us at some point think about investing, how to grow our money, how markets work, and how to make better financial decisions. But here's one important question that always stands out. If markets rise over time, why do many investors still fail to create their wealth? And why and what really drives investors' decision? Their logic or emotions? Today, me, Khushi, Heath, Ashutosh, Ashna, and Sakina, Tanish will answer these questions using insights from the book Value Investing and Behavioral Finance by Parag Paik sir, who have been in the industry for more than 30 years. A book that teaches us that investing is not just about numbers, it's about behavior. Let us begin with a simple concept, that is success and failure in investing. Most people don't fail because they lack knowledge. They fail because of how they behave. People naturally look for easy gains, which leads to chasing hot stock tips instead of doing the real research. They prefer short term comfort, so they buy when the markets are at high and panic during the fall. And over the time, these actions become habits that are hard to change. In fact, traits like greed, ego, impatience, and overconfidence are hardwired in humans. And in markets, these traits quietly drive poor decisions. This is why we see a clear difference between investors who fail and investors who succeed. Investors who fail tend to chase quick profits, react on every headline, and think in short term. But on the other hand, investors who succeed stay calm, ignore the short term noise, and think in long term. So now the question is, what actually leads to success? It's not the talent nor the intelligence. It comes down to two simple things. First is discipline of doing the right thing consistently. And second is character of building a resist greed, fear, and the urge of instant results. A simple way to understand this is through the law of farm. You cannot plant a seed today and expect to harvest tomorrow. Wealth creation works in the same way. You need time, patience, and consistency. Now, let us look to an interesting paradox where market wins, but investors don't. Over the long period, market have delivered strong returns, and yet many investors underperform or even lose their money. What's the reason of this paradox? It's not because that the company don't grow. It's because investors react emotionally. To understand this better, we need to see what actually drives returns. There are two parts. The first one is earning growth, which is fundamental, and the second one is valuation, which depends on the market sentiment. And this is where things get interesting. Even if a company performs well, the returns can still be low if expectations were already too high. When optimism rises, valuation expands and prices go up. But when sentiments changes, valuations fall and price correct, which leads to negative returns at some points. This is what we have seen recently, where earnings improved but markets corrected because expectations were too high during September 2024. And that gives us a key insight, that is, growth alone doesn't guarantee returns. It's the timing and the prices of the stock. Now, I would like Khushi to take forward the presentation.
Thank you. On this slide, I'm basically showing the gap between how investors should behave and how they actually behave. Ideally, investing is simple: focus on long term value, ignore short term noise, and stick to a disciplined process. But in reality, that's not what happens. When markets fall, fear kicks in and investors start panic selling. When markets rise, greed takes over and people chase stocks at higher prices. At the same time, most investors don't like standing alone. They follow the crowd because it feels safer. So even though the right strategy is known, it is not followed. And that's the key idea here. Investing is not a knowledge problem, it's a behavior problem. The real challenge is controlling emotions and staying disciplined. Moving on to the next slide. These are the mistakes that are driven by specific behavioral biases. Loss aversion. People hate losses, so they sell too early or hold on to bad investments just to avoid accepting a loss. Here's the herd behavior. People follow what everyone else is doing, which is why they often enter at the top and exit at the bottom. Overconfidence is another one. Investors believe that they predict the market, which leads to overtrading and mistakes. Confirmation bias also plays a role. People only look for information that supports their view and ignore anything that contradicts it. And finally, the short term thinking, focusing on quick returns instead of long term value. All of this creates a pattern where decisions become emotional, and that's what leads to poor outcomes. Moving on to the next value, contrarian investing. This slide ties everything together, though contrarian investing. What usually happens is when there's a fear in the market, investors become pessimistic and start selling. That pushes prices below their real value. Now, that this is where a contrarian investor thinks differently. Instead of following the crowd, they see this as an opportunity and invest where others are selling. Over time, as the panic fades and fundamentals start reflecting again, prices correct. So the reason is this works is simple. Markets are driven by emotions, not just logic. People overreact, and that creates opportunities. But the challenge is psychological. It's uncomfortable to go against everyone. That's always a doubt. What if I'm wrong? And that's why most people can't follow the strategy. The key takeaway is real opportunities exist when others are uncomfortable, and the real edge is investing comes from emotional strength, not just analysis. Now, I would like Heath to continue further.
Thank you, Kushi. That sets the context very well. Building on that, I'll be explaining the concept of growth track. In bull markets, investors tend to chase high growth stocks. These companies become very popular and their prices rise significantly. But in this process, investors often ignore fundamentals like valuations, earnings quality, and dividends. Now, the issue is not growth. Growth is always attractive. But the real problem is overpaying for that growth. When a stock is priced much higher than its intrinsic value, even strong business performance may not translate into good returns. This usually happens because of market psychology, media hype, new trends, and strong narratives create excitement. And investors start following the crowd instead of making independent decisions. A key insight here is that returns depend on expectations, not just growth. If high growth is already priced into that stock, the scope for the future returns become limited. For example, Infosys in the early 2000s delivered excellent growth, but it was trading at extremely high valuations. Because those high expectations could not be sustained, investors ended up earning very low returns for several years. Similarly, if we take a look at ACC and Century Textiles, Century was a market favorite with high expectations built into its price, while ACC was relatively undervalued with better dividend. Over time, ACC actually delivered higher returns simply because it was bought at a more reasonable valuation. On the other hand, companies that are not in the spotlight but show improving fundamentals, such as rising profitability or ROC, can generate strong returns due to re-rating. So the key takeaway here is don't just look for growth that is not already priced in. Because in investing, it's not just about buying good companies, but buying them at the right price. This brings us to the next slide. So we have seen how overpaying for growth can reduce returns. Now let's take a look at a slightly different but equally important concept, how investing in commodity business works. Unlike traditional companies where we focus on strong management, low debt, and consistent earnings, commodity stocks behave very differently. In fact, applying conventional parameters like strong balance sheets or stable earnings can sometimes be misleading in this space. This is because commodity business are highly cyclical. Their performance depends largely on external factors like demand, supply, and pricing cycles, not just the internal efficiency. One common mistake investors make is assuming that the sudden rise in profits is sustainable. But in reality, an exponential increase in earnings during a cycle is often temporary, not a long-term growth trend. Another interesting insight is how laggards often outperform leaders in commodity cycles. For example, improving margin from 5 to 10% is much easier than from 20 to 40%. So weaker companies or laggards show sharper improvements during cycles, which attracts investors' attention and drives stock prices higher. Now, when evaluating commodity companies, the focus shifts to a different set of parameters, like market leadership, being a low-cost producer, and the debt levels of company. Interestingly, earnings per share is not the most reliable metric here, because earnings fluctuate with the cycle. From the long-term survival perspective, low-cost producers are important, but from an investment return perspective, high-cost producers often deliver better returns during up cycles. But why does this happen? This is because high-cost producers go through significant transformation. They move from high debt to lower debt. Their margins expand sharply, for example, from 5 to 10%. Past losses act as a tax loss carry forwards for companies, boosting their earnings. And most importantly, they undergo re-rating, shifting from being seen as weak company to strong ones. This change in perception leads to sharp stock price increase movement. So the key takeaway here is in commodity investing, it's not just about efficiency. It's about where the company is in the cycle and how much improvement is possible. Now that we have understood how growth traps and commodity cycles impact returns, I'll hand it over to Ashutosh, who will take you through the next part. Thank you. Ashutosh, you are on mute.
Thank you, Heath. Till now, in this presentation, we have covered the concept of value investing and and how market prices can deviate from intrinsic value due to investor psychology, as explained by Heath. We have also seen that behavioral biases like herd mentality and overreaction lead to mispricing in the stock market. This sets the foundation for identifying opportunities where stocks are undervalued despite having strong fundamentals. Now let's try to understand public sector undertakings from the lens of Mr. Parag Parekh sir. Public sector undertakings or PSUs are companies where government has a major stake. Despite being large, stable, and often profitable, these companies have historically traded at lower valuations compared to private sector companies. This phenomenon is not always due to poor fundamentals, but largely due to investor behavior and perception. This is what we call the behavioral discount, where psychology biases lead investors to undervalue certain stocks. Moving on to next slide. Now the key question here is why does the discount exist? As we can see from points listed here, there are several reasons why investors avoid PSUs. These include like government interference, lack of efficiency, and slower decision making. Now, while some of these concerns may be valid, investors often overemphasize them. So instead of evaluating each company individually, they generalize and assign lower valuations to entire PSU category. This is where behavioral finance comes in because these decisions are driven more by perception and biases rather than complete analysis. Next slide. In this chapter, Mr. Parag sir provides the readers with the data in which he is comparing PSUs with their private counterparts. From that data, one key observation is that a typical PSU is almost 3 times larger in terms of its sales compared to its private sector counterparts. However, despite this larger size, this advantage is not reflected in their share prices or valuations. In fact, PSUs are often traded at lower price multiples compared to smaller private companies. This clearly shows mismatch, fundamentally strong and large companies, but relatively low market valuations. This gap cannot be fully explained by fundamentals alone. It indicates that investors are assigning a discount due to their negative perception. But the investors who recognized this gap and invested in PSU were able to benefit when market get eventually corrected its mispricing. Which brings us to our next slide. Here we can observe from 1991 to 2006, several PSU stocks actually outperformed the Sensex. This is interesting because despite being undervalued initially, they delivered strong returns over time. In particular, PSU banks performed very well. One of the key reasons for this was financial sector reforms after 1991, improvement in efficiency and profitability, reduction in NPAs, better regulation, and growth in credit demand. As these improvements became visible, the market globally gradually corrected its earlier negative perception, leading to strong stock performance. This reinforces a core value investing idea. Mispricing exists due to perception, but over time, markets tend to correct these mispricing. Next slide. Here, we tried to expand our horizon using more recent data from 2010 to 25, but keeping the core concept same to see whether this growth story continues after 2006. And interestingly, the trend here is somewhat different from what was in 1991 to 2006 period discussed in the book. While earlier PSUs were broadly undervalued and later performed well, in the recent period, most PSU sectors have actually underperformed the Sensex. However, there is a clear exception, the defense and aerospace PSU sector, which has emerged as a new market favorite. This shows that market is no longer uniformly discounting all PSUs. Instead, it is being selective. Sectors like defense, which have strong growth prospects and strategic importance, are now receiving higher valuations. So the key takeaway from this is the behavioral discount still exists, but today it is sector specific rather than across all PSUs. Now I would like to invite Ashna to take over and continue with the presentation.
Thank you so much, Ashutosh. Now we'll be moving on towards sector investing. When we talk about sector investing, the biggest threat is in the market. It's our own mind. The first bias is representativeness. Investors assume that just because a sector is booming, every stock in it will deliver returns. But sector performance and individual company fundamentals are two very different things. Then comes availability bias. When positive news floods the media, risks become invisible. Investors overweight what they easily recall and ignore what they don't. Herd mentality takes it further. Fear of missing out pushes the investors into overvalued sectors, not because of the analysis, but because everyone else is doing it. On the other side, anchoring keeps investors stuck to the past sector performance, even when the conditions are fundamentally changed. The winner's curse shows up when sector euphoria pushes the companies to overpay for acquisitions, attracting excessive capital and fueling overvaluation. And finally, confirmation bias. Once investors are committed to a sector theme, they filter out contradictory data entirely. Only what confirms their belief gets through. Moving to the next slide, these biases don't just affect individuals, they create sector bubbles. A rapid rise in sector weight is always a reliable bubble signal. New companies flood the market at inflated valuations, optimism and greed worsen mispricing, and the cycle feeds itself. Reliance Power IPO is a textbook case. Availability bias and herd mentality created massive oversubscription purely on the brand hype. And when the fundamentals failed to support the price, the correction was sharp. Post 1991, India tells the same story repeatedly. Capital goods and banking attracted high valuation but delivered weak returns. FMCG healthcare were ignored as boring yet delivered consistently strong returns. And tech during the dot-com era turned into a full bubble with widespread failures. The lessons are clear. Avoid chasing hot sectors, be cautious with IPOs in overheated markets. Focus on the neglected sectors with strong fundamentals, and always remember valuation matters more than the growth. Next slide, please. Talking about IPOs, initial public offerings are where all these behavioral errors collide at once. Economically, IPOs are launched during bull markets to maximize capital for the issuer, not to benefit investors. High listing price limit returns from day one. Early investors like angels and VCs have already captured most of the gains before even you get access. Psychologically, the lure of something new derives irrational demand. Recency bias makes investors forget past IPO failures. India's IPO history confirms this pattern across every cycle. Booms peak in bull market, issues are heavily overpriced, listing momentum is short lived, and many IPOs eventually underperform or disappear entirely. Parag Parikh Sir's own data proves this. Out of 1,540 IPOs between 1991 and 2000, only 43.8% gave positive annual returns. 56.2 had negative annual returns, and only 15.2 actually beat the Sensex. The odds are against you from day one. The key lessons: few win, many lose. Pricing always favors the issuer. Bull markets inflate valuation beyond reason. And the only real defense is the awareness of your own behavioral biases. Thank you. Now my co-presenter will continue.
Thank you, Ashna. Hello, everyone. I'm Sakina. Let me begin with index investing. Index investing refers to investing in a basket of stocks that make up a market index, where each stock is weighted based on its market capitalization. This means larger companies automatically get a higher allocation while the smaller ones get less. It is considered a passive strategy because there is no active decision making involved. Investors simply follow the market. Now, the reason index investing is so popular is because of a few key beliefs. Investors assume that the markets are effective and it is very difficult to consistently beat the market. As a result, they prefer a low cost and simple approach that does not require deep research. At its core, index investing is based on the assumption that market prices reflect true value. Moving on to the next slide, it shows that this assumption leads to a major limitation. Index investing allocates capital based on market prices, not intrinsic value. This creates a situation where overvalued stocks receive a higher weight while the undervalued ones remain underrepresented. More importantly, it creates what we call a self-reinforcing cycle. As stock prices rise, market capitalization increases. This leads to a higher weight in the index, which attracts more buying from index funds. That additional buying pushes prices even higher. So instead of correcting the mispricing, index investing actually amplifies it. In simple terms, price drives allocation and allocation drives price. Over time, this can disconnect prices from the true underlying value. This happened in real markets. Harshad Mehta took ACC Cement stock to rupees 10,000 through operator manipulation in 1992. Index funds automatically bought more ACC as its price and thus weight increased, exactly amplifying the mispricing you see here. When the bubble burst, it crashed 70%. This brings us to the concept of market bubbles. To the next slide. A market bubble occurs when asset price is significantly higher than its intrinsic value. This is mainly due to investor behavior rather than fundamentals. Bubbles typically form in stages. It begins with optimism, where prices are rising due to positive sentiment. This is followed by euphoria, where investors are overly confident and believe that the prices will keep rising indefinitely. Then comes excess, where heavy buying and speculation pushes prices far beyond their real value. Finally, the market reaches a fragile peak, where it becomes unstable. During this process, rational decision making fades and investor psychology takes over. Bubbles are primarily driven by greed, herd behavior, and overconfidence, rather than actual business performance. Moving on to the next slide. Here we can see every bubble reaches a breaking point. After the peak, the market experiences a sharp fall. Prices decline rapidly. Panic selling begins, and many investors incurs heavy losses. What is important to understand is that most investors enter the market at peak, when optimism is at its highest and risk is the greatest. This is why bubbles are called traps. We have seen this pattern repeatedly. Ketan Parikh's K10 stocks in 2001 followed this exact 5-stage cycle. Tech boom, cheap credit, media hype, disappointing earnings, then 80% crash. Most investors entered at the euphoria peak. From this, we can draw a few important lessons. First, investors should avoid blindly following the crowd. Second, they should focus on intrinsic value rather than market trend. And most importantly, they must remain emotionally disciplined, especially during extreme market conditions. To conclude, the biggest risk in a bubble is not the market itself, but the behavior of the investor. Thank you. And now I would like Tanish to take over.
Thank you so much, Sakina. Today, I'll be presenting on investor behavior-based finance, the missing corporate link. Let me start with the problem. Companies spend millions on understanding employees, customers, and suppliers, but they invest almost nothing in understanding their investors. Even though investors can make or break stocks overnight, the gap is where we call the missing corporate link. Now, when we talk about investors, it is important to understand that not all investors behave the same. They all differ on the base of what their investment horizon is. Looking at the three types of investment horizons are long-term investors, medium-term investors, and short-term investors. Looking at long-term investors, they are someone who invests for 5+ years, focus on fundamentals, and use models like DCF. They are not affected by short-term noise. Medium-term investors, on the other hand, are typically only there for 12 to 18 months, react to news, product launches, and sector changes. Whereas short-term investors are someone who operates in weeks or months, trades on rumors and events, buying on rumors and selling on news. So clearly, stock prices are influenced not just by value, but also by investor behavior and psychology, which brings us to a very important part where investors' mistake and smart investing is being talked about. Common mistakes include ignoring investor behavior, treating all investors the same, focusing only on large shareholders, sending the same communication to everyone, and not analyzing before major decisions have been taken. On the other hand, smart investing means understanding different investor types, mapping them based on their horizon, identifying the active traders who move prices, and tailoring strategy and communication accordingly. Coming on to the key takeaways. First, mindset is very important. Behavior matters more than knowledge. An investor must control fear and greed and learn about delayed gratification. Secondly, coming on to investing principles, always buy a good business at the right price. Avoid hypes like IPO trends and think differently from the crowd. Third is your winning edge. Discipline is more important than strategy. Patience builds wealth, and overtrading should be avoided. And finally, market reality. In the short term, markets can be irrational, but in the long term, value always wins. And most importantly, price is not always as same as the value. So to conclude, I'd like to say that successful investing is not just about analyzing numbers, it is about understanding behavior, both on the market and yourself. If you can stay disciplined when others are emotional, patient when others are rushing, and focused when others are chasing price, that is when real wealth is created. Because in the end, the biggest advantage in investing is not information, it's your behavior. Thank you.